वेलकम टू द चैनल। हमारा आज का मौजू है प्राइवेटाइजेशन ऑफ पाकिस्तान इंटरनेशनल एयरलाइन, वैल्यूएशन एंड फेयरनेस एनालिसिस। The privatization of Pakistan International Airline, in which a consortium led by Arif Habib won the bid by Pakistan rupees 135 billion for a 75% stake. It was finalized on 23rd December 2022 during a competitive reverse auction held in Islamabad. After the bids were opened on 23rd of December 2025, the Arif Habib-led group emerged as the highest bidder with a pocket rupees 135 billion offer for the majority shareholding, beating competitors such as Lucky Cement-led consortium. This transaction is expected to move into regulatory approvals and operational transition phases thereafter. The owner, the new owners are expected to take operational control by April 2026. क्या ये डील फेयर है? Keeping in view the assets, liability, and profitability? Now, first thing first, what the transaction does include. ट्रांजैक्शन में शामिल एलिमेंट्स क्या क्या हैं? Number one, 75% of the airline operating business and landing rights. Number two, new capital, in equity capital of most of the bid amount, that is 46, that is Pak rupee 124.9 billion, is to be reinvested into the airline. Government क्या रखेगी? Government shall keep 25% of equity valued at Pakistan rupees 45 billion, implying total valuation Pak rupees 180 billion. Buyer must make additional capital commitments about Pak rupee 80 billion over the next 5 years. अब आते हैं क्या चीजें इसमें शामिल नहीं थी। पीआईए पहली चीज पीआईए से लेगेसी डेट जो कि तकरीबन 650 बिलियन रुपया है. It was largely taken off the airline books and placed with the government holding company before the sale, making the airline's balance sheet cleaner but leaving taxpayers responsible for the legacy burden. दूसरी चीज, real estate and non-core assets were also not included in the transactions. Let's have a little bit of explanations. Legacy liabilities. क्या हैं? Obligations accumulated before the transaction or before the privatization. That is, old bank loans, government guarantee debt, vendor के जो बिल जो भी पे नहीं हुए, accrued employee pensions and gratuities, past losses carried past losses carried forward. These are all historical burdens. Current obligations क्या हैं? They are ongoing operation, that is aircraft leases, fuels payable, maintenance reserves, salaries and benefits, airport and navigation charges, short-term working capital loans. These are day-to-day operating commitments. Is the deal fair with the given assets? Is the deal of 135 billion rupees fair with the valuation? Let's consider valuation context. PIA asset base is estimated between Pak rupee 150 billion and 190 billion. Liabilities, that is legacy plus current obligations, have historically diverted assets contributing to prolonged losses. Recently, profit figures were tied to the government absorption of debt and structural fixes, not solely operational turnaround. If you consider just clean equity value, assets minus liability transferred out, the bid price is arguably reasonable. It pays near the adjusted net asset value. But when factoring in the fact that government absorbed most of the debt to make the airline attractive, land, real estate, and other potential non-operating assets were excluded, and the buyer gets tax incentive, that is GST exemption on aircraft purchases. Many analysts argue that the government kept most risk and liabilities while the investor gained operational upside, which could skew fairness in favor of the buyer. There are divided opinions in public debate. Some see it as a necessary step to stop the perpetual financial drain of a loss-making state-owned enterprise. Others, they claim the effective sale price to the government is much lower than Pak rupee 135 billion, since only Pak rupee 10 billion actually goes to the government in immediate cash, with the rest tied up as investment pledges and capital injections into the airline. Bottom line, on a clean restructured balance sheet basis, Pak rupee 135 billion is a defensible or at least not obviously low relative to operational assets and landing rights. But as a transaction for the whole economic value of PIA, including hidden liabilities and non-core assets, some may view the price as modest, especially given historical losses. Without detailed Without detailed audited financials publicly released before and after restructuring, there is reasonable debate about whether it fully captured the airline's long-term economic value. The comments on this transaction, the positive aspects of the transactions are: number one, reduce government fiscal burden. PIA has been a, always a drain in public finances. Privatization halts recurring losses and shifts operational risk to private management. Number two, the positive aspect is transparency of auction. The televised auction among multiple bidders adds credibility to the price discovery process. Third positive aspect is capital commitment required. The buyer must commit additional capital of Pak rupee 80 billion over the 5 years, which could modernize the airline and improve its operations. The fourth positive aspect is retain government stake. Authorities retain 25%, so the state still benefits from future upside if the airline turns around. The concern The concern points are legacy liabilities absorbed by states. A large chunk of liabilities was shifted away from the operating airline into government entities to facilitate privatization. This transfers risk back to the taxpayer. Number two, non-core assets excluded. Excluding real estate or other valuable holdings may mean the government gave up potential value to make the airline more marketable. Third concern is limited foreign strategic interest. Privatization did not attract major global airline operators as bidders, suggesting concern about long-term commercial attractiveness and profitability, which indicate valuation caution by market players. Number fourth concern, aviation industry risk. Airlines are primarily capital intensive, cyclical, and are exposed to fuel prices volatility and global travel demand swings. Success depends upon competent aviation experience management execution. Final assessment, immediate, there's the aspect of immediate fiscal relief. Yes, it is strong. Price versus asset valuation, there is mixed opinion dependent on assumptions. Long-term investor upside, possible if turnaround succeeds. Taxpayer protection from liabilities, government absorb most of the risk. Transparency and process quality, yes, it was good. Summary, the deal represents a pragmatic privatization outcome given decades of losses and political complexity. The price appears reasonable on a restructured balance sheet basis, but not on definitely high relative to all economic value PIA might have had if it fully leveraged or restructured different. Its balance sheet fiscally necessity against market appetite, but value capture for the public could have been stronger if non-core assets or liabilities treated differently. No, the transaction is 75% stake sold to Arif Habib-led consortium at the price of 135 billion. Its implied equity value as Pak rupees 180 billion. Valuation framework use. Since PIA lacks transparent market comparables and clean historic financial, valuation must rely on three standard approaches. That is, adjusted net asset value ANAV releases relevance to PIA, it is high. Comparable airline multiples, it can be considered as medium. Forward EBITDA oblique cash flow potential, it is medium to low as it being relevance to PIA. Adjusted net asset value as a core benchmark. Asset category, conservative value, and notes. Aircraft. The conservative value of aircraft is 90 billion, mostly older fleet. Spare parts and inventory, about 15 billion. Verified operational assets. Receivables and cash is 20 billion that can be considered as working capital. Landing rights, slots, routes, 35. Scarce and strategic value, the most important asset. IT system, brand licenses 15, conservative. The total operating assets becomes about 175 billion. Now, while evaluating the liabilities retained in airline, trade payables and accruals about 25 billion, employees obligations net about 15 billion, short-term borrowings 10 billions, total retained liabilities 50 billion. Therefore, adjusted net asset value is equal to approximately 175 minus 50, that is Pak rupee 125 billion. The key point here is the government removed Pak rupee 600 to 650 billion of legacy debt before sale. So the buyer is purchasing a clean airline, not a historic PIA. Comparison with deal prices. AVAN 100%, Pak rupee 125 billion. Deal employed in equity 100%, 180 billion. Premium over ANAV plus 45%. On assets basis, buyers pay a premium, buyers paid the premium, not a discount. Now, comparable airline valuation reality fact sheet. Using low cost and legacy airline benchmarks discounted for PIA risk. Metric conservative multiple PIA. Revenue 0.3 by 2 0.6 0.5 PTR 240 billion. Implied EV 72 to 120 billion. EBITDA 4 times to 6 times, that is Pak rupee 15 to 20 billion normalized. Implied EV 60 to 125, 120 billion. Example, PIA style simplified. Equity paid by investor, Pak rupee 135 billion. Debt retained by government, 600 billion. Cash transferred, 0. Implied EV of airline is Pak rupee 135 billion. Compared table-based valuation range. Pak rupee 80 to 120 billion with 100% equity. Bid price Pak rupee 180 billion is above peer implied value, reflecting monopoly rules, national carrier slot rights, and upside optionality. Cash flow, the hard truth. Best case normalized operational scenario, 3 to 5 years. Aspect, item, revenue, 280 billion. EBITDA margin 8 to 10%. EBITDA 22 to 28. Maintenance capex 15. Free cash flow 7 to 12. At Pak rupee 180 billion equity value, FCF yield 4 to 6%, not cheap, not excessive, high execution risk. By EBITDA we mean earning before interest, taxes, depreciation, and amortization. And by FCF we mean free cash flow yield. In simple terms, how much real cash the business throws off compared to its purchase price. EBITDA is operational strength. FCF yield is investor return quality. Now, what the buyer really bought? Buyer really bought clean airline, no legacy debt. Yes. Monopoly, protected routes. Yes. Fleet renewal upside. Yes. But has, but also got political risk, labor restructuring challenges, a very big challenge, and fuel foreign exchange volatility. Very important. So, this is not a steal, it is a high risk turnaround back. What the government really sold loss-making state-owned enterprise. Yes, absorb historic debt, taxpayer burden. It goes to the finally it is to be paid by taxpayer. Stop annual cash bleeding. Still retain 25% upside, that is equity, excluded real estate, avoided future bailouts. Economically, government paid the past and sold the future. Was PKR 135 billion fair? From investor perspective, reasonable but not cheap. Require strong management execution. Value depends on labor reform and fleet renewal. From the government perspective, stop fiscal hemorrhage, politically and economically pragmatic, public value diluted by debt absorption. Independent verdict. Was it underpriced? I think. No. Was it aggressive pricing? No. Was it market clearing? Yes, it can be said that. Was it a deal? Does not, don't think so. Was it necessary? Yes. Final professional judgment. This was least bad deal, not a sweetheart deal. Given PIA history, risk profile, and absence of foreign strategic bidder, PKR 135 billion is within a fair valuation band after restructuring. The real test is not the price, it is execution. Now, coming to policy and risk analysis. Why foreign investor did not pitch? This is because PIA has no value. It is according to their point of view. It is because foreign strategic airline price risk very differently. They think A. Political and sovereign risk, primary reason. Foreign airlines require route freedom, labor flexibility, pricing autonomy, and regulatory certainty. All these four factors are very important. Pakistan scores weekly on Pakistan scores weekly on a policy continuity, which is a big concern by foreign airlines. Contract enforceability, aviation regulatory independence. A foreign airline fears policy reversal risk more than financial losses. B. The important thing is labor and human capital constraints. PIA has strong unions, high staff to aircraft ratio, political employment legacy. What foreign airline wants? ability to downsize or redeploy, performance-linked pay and perks, non-political HR decisions. Labor flexibility is a deal breaker for strategic airlines. तीसरी वजह fleet and network misalignment. Foreign airlines prefer modern, homogeneous fleets, profitable hub economics, cargo passenger optimization. पीआईए के इश्यूज क्या हैं? एजिंग मिक्स फ्लीट, subscale network, weak cargo monetization. Strategic buyers prefer building organically over inheriting complexity. Chauथा concern, sanctions, compliance, and reputation risk. EU bans, safety scrutiny history, FAA, EASA, perception risk. Foreign airlines cannot risk brand contamination. This is very important. E. Financial return versus opportunity costs. A foreign airline asks, why deploy capital here instead of India, Vietnam, Africa, or Latin America? PIA risk adjustment return less than alternative. This is rational capital allocation, not a Pakistan specific insult. Conclusions. Foreign airlines avoided PIA not due to price, but due to uncontrollable non-financial risk. Domestic conglomerates can manage these risks better than the foreign investors. Who bear the real risk? Taxpayers versus investors. Risk allocation table. Operating losses. It is it is the investor headache, not taxpayer. Fuel price volatility. It is investor responsibility. Foreign exchange risk. The risk is assumed by investor. Labor restructuring cost by the investors. Capital future expenditure by the investors. Legacy debt not by the investor but by the ultimately by the taxpayer. Pensions obligation historic not by the investor but by the taxpayer. Guarantees already issued not by the investigator but by the taxpayer. Policy reversal risk, it's a warning symbol for most of the time. It means caution, there is meaningful risk that government policy could change or be reversed. Therefore, proceed carefully. Future policy changes could affect outcomes. Financial reality PKR 600 to 600 billion liabilities remain with the government. These are sunk costs already owned regardless of sale. If PIA paid public more losses every year. The deal stops the bleeding, it does not erase the wounds. C. Risk over time frame from the 0 to 2 year. Who bear the risk? It is taxpayer. Medium 3 to 7 years. Investors. Long term, that is plus 8 years. Investors. Once privatized, any blue loss is not public. Taxpayer bear the past, investor bear the future. This is consistent with global airline privatizations. Effect on potential passengers. A short term 0 to 18 months. Areas and impact. Fares, kiraya, slightly higher on monopoly routes. On-time performance could be gradual improvement. Service quality mixed. Route continuity maintained. Government typically includes route continuity obligations. Medium term 2 to 5 years. Safety and compliance stronger. Reliability better. OTP on time performance. Cabin quality, fleet refresh. Digital services could be improved. Long term plus 5 years scenarios. Successful turnaround. Better service, stable fares. Partial failures. Reduced routes, higher fares. Full failures. Market exit. Foreign carriers fill the gap. Conclusion. Passengers generally benefit from privatization unless monopoly power is abused, which requires regulatory oversight. Passengers are protected by competition, not ownership. Impact on public due to retained liabilities. Economic reality is important. These liabilities are already existed, already guaranteed, or already accruing interest. Privatization does not create new public debt. Fiscal comparison scenario. If government keep PIA as public as state-owned enterprise, continuous annual losses. If privatized as done, one-time test, one-time debt crystallizations. Privatization converts recurring fiscal hemorrhage to non-fixed cost. Public perception versus economic truth. Perception. Public paid for private profit. Public paid for historic mismanagement. That is the reality. Assets were given away. Assets were monetized post cleanup. Taxpayer lost money. Losses already incurred. That is the reality. Long-term public impact. Budget predictability would be improved. IMF confidence improved. Aviation sector health impact improved. Political interference reduced. Conclusion. The public pays once instead forever. This is painful but fiscal reality. Physical rational. Final strategic verdict. This privatization is not about selling cheap. It is about exiting a structured trap. Foreign airlines avoided sovereign and labor risk. Domestic capital accepted execution risk. Taxpayer absorbed historic damage. Passengers likely gain better service and safety. With this, we conclude our discussion on today's subject of valuation and fairness related to PIA privatization. Thank you and thank you very much.